continuation patterns. When trading this market, you can use reversal patterns that we looked at in the last video, like double bottoms, head and shoulders, etc., to enter a trade at the point of a trend change. But how do you safely enter a trade in the middle of a trend? Well, this is where continuation patterns come in. There are a few types of continuation patterns, all very similar, where essentially the price action briefly consolidates before continuing higher. These points of consolidation are excellent points of entry for a trade. But let's talk about the number one continuation pattern, the bull or bear flag. A bull flag is a bullish chart pattern that resembles a flag visually. The pattern occurs in an uptrend where the stock pauses for a time and pulls back to some degree and then resumes the uptrend. A bull flag must have orderly characteristics. And what I mean by this is there must be a series of lower lows in the price action and lower highs. Low volume should also accompany this price action within the flag. After this period of consolidation has completed, the flag must resume upwards in order to be considered an actual legitimate bull flag. Otherwise, the pattern is invalidated. A bull flag essentially means that there is a brief pause in the price action or upward momentum of a coin or token before it continues upwards again. It indicates that the coin or token might be temporarily overbought, which will likely bring some early selling pressure in a young bull run. However, once the stock has had a chance to pull back and consolidate, the bull flag should produce a breakout, allowing the stock to resume its prior momentum. This means that sellers are still far fewer than buyers. In other words, there are more traders willing to buy the flag than there are sell it. Let's take a look at how to spot a bull flag in real price action. This is Sol, and we're going to use this as an example of how to identify continuation patterns in the price action so we can enter a trade safely in the middle of a trend. We'll be looking for bull flags, bull pennants, falling wedges, and ascending triangles, which we've already seen a couple of times today already. The trend has obviously long since been in an uptrend, so how would we have got into this price action at any given point in the middle? Firstly, we need to try and find these patterns. So this looks like it is a descending wedge. That's the first continuation pattern we've managed to identify. Here's another one. This looks like a traditional flag, parallel lines. Let's have another look at this one. Falling wedge, and let's have a look at this, see what we can figure out here. This looks like a more traditional flag. Actually, no, we'll call that a descending wedge. Here we go. So we've identified 4 continuation patterns in this price action. There's many more. There's a little bull flag playing out right now up here. There's a little flag here and so forth. But these 4 look very similar. We have a falling wedge here. We have 2 parallel lines, which make this a traditional bull flag. We have a bull pennant here, and then another falling wedge here, all of which, as you can see, resemble flags ultimately. Once you've identified your continuation pattern, you need to, of course, wait for it to be confirmed. So let's zoom in and see what that would look like. So the price action is in an uptrend and then it starts to pull back. We identify the flag and then we simply wait for the price action to break above the upper trend line. In this case, the price action breaks up, it retests the line and then continues up. So it's a clear-cut buy the breakout strategy for trading continuation patterns. The price action would have a candle close above the upper trend line. You would then simply enter the trade there. Now, you could then sell, take profits, and then wait for another continuation pattern to form, wait for the breakout, and then buy in again, and then ride the price action up until once more we enter another continuation pattern. So what this allows us to do is to benefit from the upwards movements in the price action, but not have to hold a coin or token while it consolidates briefly downwards. The added benefit of this strategy is that you can increase your profits whilst mitigating risk. So if I was to simply buy here and hold this token until it reaches the top, that's fine, I will have those profits. But at any of these pullbacks, the price action could roll over and erase any gains which I've made, whilst also minimizing the profits I can get, because the price movement from here to here is 31%, but the price action from here to here is 12. The price action from here to here is 10. The price action from here to here is 12. The price action from here to here is already, we've exceeded the profits we would have received if we just held the token, because we're only benefiting from the upwards movements and not the pullbacks. This also has the added benefit of protecting us from potential breakdowns or rollovers in the price action. Today we've just looked at how to identify bullish continuation patterns. We've looked at bull flags, we've identified a bull pennant and a bullish falling wedge, and there's a couple more as well which you can look to find. But there is also, of course, the inverse of all of those patterns for use in a downtrend: bear flag, bear pennant, bearish rising wedge, etc. So you can use these to help successfully and securely enter in an uptrend or a downtrend while mitigating risk. So which continuation pattern would you trade in a downtrend? We looked at a uptrend today, but what would you trade in a downtrend? The answer is B. This is a bear flag, the complete inverse of the bull flag, and you can trade this in exactly the same way for a downtrend as you would trade a bull flag for an uptrend. In the next video, I will be breaking down a 70% buy the breakout trade that I performed last week. So stay tuned for that. Until then.